Hello everyone, I'm Negin and this video is about loan amortization. To explain, suppose you want to buy a house. You go to a lending company and get a loan. Then you buy a beautiful house. Now is the time to repay your loan. Amortization is the way the borrowed amount or principal is repaid over the life of the loan. So in amortization loan, each loan payment has some payment of principal and interest payment. This is an amortization table. The first column is payment period. It can be monthly or yearly, depending on the loan agreements. Beginning principal balance, that's the amount you borrowed. It starts with beginning principal balance and decreases as we pay our payments each period. Total payment, that's the amount you should pay at the end of each period. You can calculate it with financial calculator and solve for PMT. Interest paid. This is a portion of total payment that consists of the interest paid. We can calculate it by multiplying beginning principal balance by interest rate. Principal paid. This is the relationship between total payment and interest paid and principal paid. So to calculate principal paid, we subtract interest paid from total payment. Ending principal balance equals beginning principal balance minus principal paid. So this is an example. Amortization table, we're going to make an amortization table for when we borrow $200,000 with yearly payment periods at 5% interest rate and 3 years to repay the loan. So our table has 3 rows for 3 payments at the end of each year. If we had monthly payments for 3 years, our table would have 36 rows for 36 payments, 3 times 12 months. The first year beginning principal balance is $200,000. For calculating total payment with financial calculator, we solve for PMT. Our PV is $200,000. Our N is 3. We have to pay in 3 years, and the payments are yearly. Interest rate 5%, and our future value should be 0. And we solve for PMT, and we get this number, and enter it in total payment column. For interest paid and principal paid, this is the relationship. So to calculate interest paid, we have beginning principal balance times interest rate, and we get $10,000 interest paid for the first year. To calculate principal paid, we have total payment minus interest paid, we get principal paid, this amount. For ending principal balance, we have beginning principal balance minus principal paid, and we get this number. And this number is the beginning principal balance for the next year. And we repeat the calculation until the loan is amortized and the principal balance goes to 0. So we calculate again the interest paid and principal paid and ending principal balance, the difference between beginning principal balance and principal paid. Again, the ending balance becomes the beginning balance. And we fill in the last row. And finally, an ending principal balance goes to 0. And we're done. Thank you for watching.